Bill Hwang's rise in the financial world was nothing short of extraordinary. From his beginnings as a Wall Street trader to becoming the founder of Archegos Capital Management, Hwang built a personal empire valued at a staggering $36 billion. But with rapid success came even quicker downfall. In 2021, Archegos' collapse sent shockwaves throughout the financial markets, threatening to bring Wall Street to its knees. The implosion, driven by highly leveraged positions in stocks like Viacom CBS's and Tencent, resulted in billions of dollars in losses for global banks and exposed the dark side of unchecked financial risk. Hwang, once hailed as a brilliant investor, became a central figure in one of the most dramatic collapses the financial world had ever seen. The rise of Bill Hwang, from humble beginnings to Wall Street success. Bill Hwang's journey began far from the skyscrapers of Wall Street. Born in South Korea, Hwang immigrated to the United States, where he pursued higher education and eventually found his way into the world of finance. His big break came when he landed a role at Tiger Management, the legendary hedge fund run by Julian Robertson. Under Robertson's mentorship, Hwang quickly proved himself to be a talented and ambitious trader, earning him a spot among the elite group known as the Tiger Cubs. After leaving Tiger Management, Hwang founded Archegos Capital Management, a family office that managed his personal wealth. At Archegos, Hwang's influence in the market grew quietly but significantly. He employed a bold investment strategy, leveraging his positions in a select group of stocks. This aggressive approach, which relied heavily on total return swaps and massive borrowing from major investment banks, allowed him to control billions of dollars in market value with relatively little capital. Hwang's ability to take enormous positions without drawing much attention allowed Archegos to soar to incredible heights. The firm grew to manage a portfolio worth tens of billions, with Hwang at the helm, using his sharp instincts to generate huge returns on investments. Archegos' rise seemed unstoppable, positioning Hwang as one of the most powerful yet under-the-radar players in global finance. Archegos Capital Management, the quiet giant in the market. Archegos Capital Management was not your typical hedge fund. Operating as a family office, the firm managed Bill Hwang's private fortune, allowing it to fly under the radar of regulatory scrutiny that traditional hedge funds face. This structure gave Hwang significant freedom to execute his aggressive investment strategies without the oversight that would typically accompany such large-scale market maneuvers. Hwang's investment approach revolved around the use of total return swaps, a complex financial instrument that allowed Archegos to build massive positions in companies like Viacom CBS, Tencent, and Discovery without owning the underlying stocks directly. By using leverage, Hwang could amplify his buying power and control billions of dollars in market value with a fraction of the capital. Major investment banks played a crucial role in fueling Archegos' meteoric rise. These banks provided Hwang with the financing needed to sustain his highly leveraged positions, confident in his track record and ability to generate impressive returns. However, the lack of transparency and regulatory oversight meant that few realized just how exposed Archegos and the banks had become. The implosion, how it all came crashing down. The collapse of Archegos Capital Management in March 2021 was a dramatic and devastating event that unfolded over just a few days but had massive repercussions for global financial markets. The downfall began when several of Archegos' over-leveraged positions began to sour, leading to margin calls from major banks. As Archegos had taken on highly concentrated positions in a few key stocks such as Viacom CBS, Tencent, and Discovery, these margin calls quickly spiraled out of control. On March 23, 2021, Viacom CBS's stock price plummeted after a poorly received stock offering, triggering the first of many margin calls from banks like Credit Suisse, Nomura, and Goldman Sachs. Unable to meet these demands for additional collateral, Archegos was forced to begin liquidating its massive holdings. This triggered a panic-selling scenario that sent shockwaves through the market. As banks began dumping Archegos' positions, the prices of these stocks plummeted even further, creating a domino effect that wiped out approximately the $100 billion in shareholder value. The extent of Archegos' exposure and the highly leveraged nature of its positions soon became clear to the banks involved. Realizing the magnitude of the problem, banks scrambled to unwind their positions, but the damage was already done. Archegos had amassed huge positions using borrowed money, and the sudden decline in the value of its holdings meant the firm was unable to cover its debts. In the frantic final days of Archegos, Hwang attempted to stabilize the firm, reportedly making desperate appeals to banks for time to recover. However, the banks, facing massive losses themselves, were unwilling to wait. By the end of the week, Archegos was forced into liquidation, leaving behind a trail of financial ruin. The collapse left major financial institutions reeling, with total losses for banks estimated at over $10 billion. Credit Suisse alone reported a loss of $5.5 billion due to its exposure to Archegos. The firm's implosion was one of the largest financial collapses since the 2008 crisis, and it highlighted the dangers of excessive leverage and the opaque trading practices employed by some hedge funds and family offices. The aftermath: legal battles and financial ruin. The collapse of Archegos quickly drew the attention of regulators and prosecutors. Bill Hwang was indicted on charges of market manipulation, wire fraud, and racketeering. Prosecutors alleged that Hwang had engaged in deceptive practices to artificially inflate the value of the stocks Archegos held, misleading banks and the market about the size and risk of his positions. The U.S. government's case against Hwang centered on claims that Archegos had hidden the true extent of its stock purchases through the use of total return swaps, allowing the firm to amass positions far larger than what was publicly known. As the stock prices of Viacom CBS, Tencent, and other companies began to decline, the hidden risks became apparent, leading to the swift collapse of Archegos and the massive losses suffered by banks. In addition to the legal consequences faced by Hwang, the major financial institutions involved with Archegos also came under scrutiny. Credit Suisse, Nomura, and other banks that had lent billions to Archegos faced investigations into their risk management practices, as well as significant financial losses. The fallout from the Archegos collapse raised serious concerns about the adequacy of regulatory oversight in the financial industry. What went wrong? Analysis of Archegos' downfall. The implosion of Archegos Capital was largely a result of its high-risk investment strategy, which relied heavily on leverage. Hwang's use of total return swaps allowed Archegos to take on enormous positions in a handful of stocks without owning them outright, which meant the firm could amplify its exposure with relatively little upfront capital. This strategy worked well while stock prices were rising, but became catastrophic when prices began to fall. The lack of regulatory oversight for family offices like Archegos also contributed to the collapse. Unlike traditional hedge funds, family offices are subject to fewer disclosure requirements, allowing Archegos to quietly accumulate massive positions without attracting attention. This lack of transparency meant that banks were unaware of the true scale of Archegos' risk until it was too late. Ultimately, Hwang's aggressive trading behavior spiraled out of control as his firm became over-leveraged. When stock prices dropped and margin calls came in, Archegos was unable to meet its obligations, leading to the swift and brutal collapse of the firm. That's all for today's video, and I hope you enjoyed it. If so, please make to like, share, and subscribe for more amazing videos.